Okay, let's unpack this. You've been through the whole emotional roller coaster, right? You found the perfect property, you somehow survived the bidding wars, and your offer is finally accepted.
Yeah.
And you get that incredible surge of relief. You think, okay, the hard part is over.
Right. Time to celebrate.
But then
Mm.
then the documents start flooding in,
Mm.
and they all point toward the true financial finish line, which is the closing.
Mm.
It's supposed to be this triumphant moment where you get the keys, but I think for most people, it feels more like wading into this, I don't know, this opaque swamp of fees and
It
requirements.
really is the moment the high five stops
Mm.
and the heavy lifting of ownership transfer actually begins.
Yeah.
We're diving deep today into that critical and, yeah, often overwhelming financial event known as the real estate closing. It's where all the promises, all the contracts, and all the financial mechanics, they just all converge into one single massive stack of paper.
And that's our mission today, based on your really comprehensive set of sources. We want to completely mystify these closing costs. We're going to define them. We'll break down that intimidating laundry list of fees. And maybe most importantly, figure out not just what they are, but who is on the hook for paying which cost, the buyer, the seller, or, sometimes it's a strategic split between them.
What's fascinating here, though, is that the core definition itself, it kind of strips away the mystery right away. Closing costs are simply the administrative and legal fees paid at the precise moment the title to the property is legally conveyed.
Convey, that's one of those legal jargon words.
It is. It just means handed over. It's the legal transfer of ownership to the buyer. And crucially, because these costs can be split between the buyer and the seller, they are, by their very nature, subject to negotiation from day one.
Exactly. So we're not talking about surprising hidden charges that pop up out of nowhere. We're looking at the foundational expenses that are required by, the state, the county, the bank, just to make sure this whole transfer is both legal and financially secure. So by the end of this deep dive, when you see that final settlement document, that big summary of where all the money went, you should be able to look at every single line item and understand not just what the fee is, but why the entire system demands it.
The goal is to move from feeling overwhelmed to feeling, informed and empowered.
Exactly.
To start, I think we have to look at the bedrock. These are the essential pillars of cost, the fees that ensure the transaction is legally sound and that the title is clear. I mean, without these, no legitimate transfer, especially one involving a big commercial lender, can possibly happen.
So these are the non-negotiables.
Absolutely. We're talking about costs mandated by law, by the government, or by the institutions holding the mortgage.
Okay, so where do we begin?
We begin with the human element, the legal representatives.
Yeah.
Let's talk about attorney fees.
Okay.
These are the charges for, the preparation, the review, and the official recording of all the documents involved in transferring the title and setting up the mortgage.
The attorney's role here sounds pivotal, just to make sure everything is legally sound.
It is. And this is where you really see regional differences come into play. In some states, they're often called settlement states, an attorney is actually required to run the entire closing process.
So they're like the master of ceremonies for the whole event.
That's a great way to put it. They act as the settlement agent, overseeing the exchange of funds, the signing of every single document. In other places, their role might be more limited. Just representing one party's legal interests.
And the sources bring up a potential complexity here, which is that these fees can be paid by the buyer, the seller, or even both.
Right.
It's critical to note that the principals, that's the buyer and seller, they might each hire their own separate attorney. But then the lender might also require their own separate legal representation.
That's a key distinction. You could potentially have 3 different legal bills, all for the same transaction. Yeah. The buyer's lawyer is making sure the buyer's rights are protected. The seller's lawyer is making sure they're indemnified after the sale. And then you have the lender's lawyer, who, from the bank's perspective, is arguably the most critical component.
Okay, so why do these big institutional lenders almost always insist on having their own lawyer review everything, even if there's already a settlement agent running the show?
It's all about protection. I mean, think about the risk they're taking. A lender is advancing, $500,000 or more on the promise that if the buyer defaults, they can seize and sell that asset.
Okay.
They need absolute rock-solid assurance that the mortgage documents, the promissory notes, the deed, that they were all prepared exactly correctly, following all these super specific state and federal rules.
So one tiny mistake could jeopardize their claim to the house.
Precisely. The lender's attorney ensures that the paperwork can stand up to legal scrutiny in foreclosure court. It protects the lender's collateral from any tiny clerical or legal error. I mean, if a single comma is wrong in the legal description of the property, their claim could be compromised.
Wow. So attorney fees are really just the cost of legal certainty in a system that is built on paper.
Exactly right. And moving on from that legal preparation to, let's say, legal proof, we have the title service costs. This is all about proving the person selling the house actually has the legal right to sell it.
And that the title is clean.
And that the title is clean, yes.
So what are the main components that make up these title service costs?
Well, title services usually have three main parts: the title search, the issuance of title insurance, and then sometimes, little ancillary costs related to the service.
Let's start with the search. What is that?
The title search is like an archaeological dig into the property's history. They go back decades, sometimes longer.
And what are they looking for?
They're looking for issues. Old mortgages that were never properly released, outstanding property tax liens, judgments against previous owners, or claims from heirs who didn't even know the property was sold 50 years ago.
That sounds like a monumental task, checking every single financial and legal hiccup the property has ever had.
It is, and the necessity here is absolute. The search is mandatory for any institutional or commercial lender because they simply cannot lend against the property if there's even a shadow of a doubt about who really owns it.
Right. And I imagine the buyer wants that certainty too.
Of course. It's often mandated by the real estate contract itself.
Yeah.
I mean, no buyer wants to accidentally purchase someone else's legal problems.
Okay, so once the title is confirmed, to be clear, that leads right into the insurance part. We're talking about title insurance.
Mm-hmm.
I've heard this described as the only insurance you pay for once, but it protects you forever against problems from the past. Is that about right?
That's a perfect way to put it. Unlike your homeowner's insurance, which covers future damage like a fire, title insurance covers historical defects, things that happened before you bought the house.
Interesting.
And there are actually two policies issued. This is important. There's the lender's policy and the owner's policy.
Okay, what's the difference?
The lender's policy protects the amount of the mortgage loan, and the owner's policy protects the buyer's equity and the full purchase price of the home.
That distinction feels really crucial. The lender's policy is required by the bank, right?
Mm-hmm.
But the owner's policy, even if it's technically optional, sounds like something you'd be crazy to skip.
It's universally advised, yes. You would never want to buy a property and risk losing your entire investment to some undiscovered claim just because you skimped on the one-time premium for the owner's policy.
So who typically pays for all this?
Well, the specific contract always dictates who pays. But our sources indicate that in many jurisdictions, the seller often ends up paying the majority of the title costs, especially for that owner's policy. It's often seen as the seller's responsibility to deliver a marketable or clear title.
Got it. And I remember the sources mentioning that sometimes the attorney is the one who actually performs the title search, which would combine those fees.
Exactly. It shows how these services can blur together. Legal review and historical fact-checking are often done by the same professionals.
Okay. So once the legal and title clarity is established, that's when the government steps in to formalize everything and, of course, get their cut.
Of course. We move into the realm of necessary government fees.
First up is the pretty straightforward recording cost.
Right.
This is literally the fee charged by the local government, usually the county recorder's office or the registry of deeds, to physically or digitally enter an official public record of the change in ownership.
It's essentially a service charge. It's what makes the transfer of title legally binding in the public sphere. I mean, without the deed being officially recorded, your claim to the property really only exists between you and the seller.
So the recording fee makes it official for the whole world.
Exactly. The government mandates this process to maintain a clear chain of ownership for all land within its borders.
And tied directly to that is an often overlooked expense: the document or transaction stamps or taxes. The source defined this nicely as an excise tax on the transaction itself.
And that distinction is vital. The recording cost is for the service of logging the deed. The transfer tax, or stamp tax, is just a revenue generator for the jurisdiction.
So it's a tax on the privilege of doing the deal.
That's it. It's a tax on the privilege of conducting a big economic activity like a real estate sale.
Yeah.
And it's often based on a percentage of the sale price.
So the government gets its cut in two ways: a flat fee for the paperwork and a proportional tax on the deal itself. And who pays depends on local laws or customs.
Absolutely. Finally, in this mandatory section, we have to address the physical certainty of the property, which is the survey fee.
Okay.
This is the cost charged by a professional surveyor to confirm the specific lot size, the dimensions, and critically, to check for any property line conflicts or physical issues like encroachments.
Can you define an encroachment for us?
An encroachment is when a structure, like your neighbor's fence or their new deck or even a utility line, physically crosses over the defined boundary of the property you are buying.
Ah, I see. And let me guess, the lender requires this.
Once again, this fee is specifically required by institutional and commercial lenders. When they lend money, they're lending against the value of the land and the structure. If the boundaries are wrong, or the property is actually smaller than advertised, or there's some hidden dispute over the property lines.
The value of the collateral is immediately compromised.
You got it.
It's fascinating how many of these mandatory fees are basically just protective shields for the lender. The attorney protects the document, the title search protects the history, and the survey protects the physical dimensions.
The common thread in this whole first section is risk mitigation. Every one of these, costs, legal prep, title check, government recording, and the physical survey, is a requirement enforced either by the state or the lender to eliminate uncertainty before that huge loan check gets written.
These are the foundation costs, the ones you just have to pay.
They are.
Okay, so with that legal and physical foundation locked down, we can move into the second category of closing costs. This is where we get into the largest costs in the transaction and the fees related to structuring the loan itself.
Right. We're moving from the legal necessities to the raw financial mechanics of the deal.
And I think we have to start with the elephant in the room.
The one in the tuxedo, yes.
The cost that our sources almost universally cite as one of the largest closing costs for the seller, and that is, of course, the brokerage commission.
We should definitely spend some time here because its financial impact can overshadow almost every other fee we're going to talk about. This is the compensation paid by the seller to the real estate broker or brokers involved.
And it covers all their services, right? Marketing the property, the professional photos, finding and vetting a buyer, helping with all the complex negotiations.
All of that. And the structure is key. This fee isn't decided at the closing table. It's established way earlier in a formal binding contract called the listing agreement, which is signed between the seller and their listing broker.
And it's calculated as a percentage of the final sale price.
Correct. And while that percentage is always negotiable, the traditional industry model has hovered around, 5 or 6% of the sale price.
Okay, let's put that into real-world context for our listeners. If you sell a home for $500,000 at a 6% commission rate, that's $30,000.
Mm-hmm.
If you sell for $1 million, that's $60,000. I mean, that single line item probably dictates the seller's net proceeds more than anything else combined.
Absolutely. And this is where the incentive structure that drives the entire industry comes in. The sources explain the standard division of that commission. The listing broker, who got the contract with the seller, offers the buyer's agent a big chunk of that total commission, often half.
So if the total commission is 6%, the listing broker might take 3% and then offer the other 3% to whichever agent successfully brings a buyer to the table.
That's it. That is the incentive that fuels the activity of buyer's agents. It creates a self-sustaining market ecosystem. The seller agrees to a total marketing cost, and that cost funds the efforts of both the selling side and the buying side, ensuring the maximum number of qualified buyers see the property.
It's the cost of market access and professional service.
It is. And even with alternative models out there, flat fee, discount brokerages, the traditional percentage model is still dominant in most areas. It's the unavoidable centerpiece of the closing cost discussion.
It's truly enormous. Okay, moving from the market facilitators to the financing facilitators. Let's talk about the costs for getting the buyer's mortgage. First up, mortgage application fees.
These are paid by the buyer to the lender, specifically to cover the initial cost of processing the loan application. This is for the administrative work, running credit checks, looking at the preliminary documents.
It's kind of like the lender's cover charge.
Yeah, that's a good way to think of it.
Yeah.
It covers their overhead for the initial vetting, whether the loan actually closes or not.
And the timing on this can vary, which is an important point for a buyer to track, right?
Absolutely. The sources note that sometimes the buyer pays this application fee directly when they submit the loan package, weeks or even months before closing.
And other times?
In other cases, that fee is rolled into the overall closing costs and it's just paid at the closing table. The buyer really needs to have clarity on that to manage their cash flow and, avoid accidentally paying the fee twice.
Right. Okay. After the application, the next major hurdle and another mandatory cost is the appraisal fee.
Mm-hmm. This is charged by a licensed professional appraiser, and is almost always required by the lender.
And this is one of the most critical risk mitigation tools for the bank.
It is. And while it's usually paid by the buyer, the sources do mention that in some negotiations, maybe in a buyer's market where the seller needs to offer an incentive, the seller might agree to cover this cost.
But no matter who writes the check, the appraisal serves the lender's interest first and foremost. Why is that verification so absolutely critical to the whole loan process?
Because the lender has to verify that the sale price is equal to, or ideally, less than the fair market value of the property.
Okay.
If the sale price is, say, $600,000, but the appraisal comes in at $580,000, the bank will typically only lend based on that $580,000 value. They won't lend on an inflated price.
So the appraisal protects the lender's investment against, like, the emotional or irrational market forces that might have led to the buyer's high offer.
Precisely. It makes sure the underwriting is based on sound collateral value.
So that brings up a good question. What happens if the appraisal comes in low and the deal falls apart because the bank won't finance the full purchase price? Is the buyer still on the hook for that appraisal fee?
Generally, yes. The appraiser performed the service, they did the work, and they had to be paid for their time. The fee is for the professional opinion, not for the successful closing of the loan.
So it's a non-refundable expenditure, a risk the buyer takes.
It is. It's money spent before you have total certainty.
Okay, that makes sense. Now let's move to one of the most confusing pieces of loan jargon out there, points.
Yes. Points are fundamentally a form of prepaid interest. The buyer pays them to the lender.
Prepaid interest. So you're basically buying down your long-term interest rate.
Exactly. It's a strategic choice. This is not a mandatory administrative fee like an application charge. The buyer is deciding to spend more cash up front in exchange for a lower monthly payment and lower overall interest paid over the life of the loan.
So you have a choice. Keep the cash now and pay a higher interest rate, or spend the cash at closing to lock in a better rate.
That's the strategic decision right there.
Okay, the math here needs to be broken down because it's very specific and really actionable for our listeners.
Let's do the math. 1 point equals 1% of the total loan principal. So if you're taking out a $400,000 loan, 1 point costs you $4,000 up front at closing.
That's the cost side. And what's the typical benefit you get for that $4,000?
The standard benefit, though it can vary, is that 1 point usually reduces your annual interest rate by 1/8%. That's 0.125%.
So if you were offered a base rate of, say, 6%, paying 3 points, which would be $12,000 on that $400,000 loan, might drop your rate down to 5.625%.
Exactly. And for a 30-year mortgage, that reduction can save you tens of thousands of dollars in interest over the long haul.
That really puts the buyer in the driver's seat. And the sources also note a scenario where the seller might get involved here too.
Yes, often in negotiations, instead of just lowering the overall sale price, a seller might agree to pay for 1 or 2 of the buyer's points.
Ah, a seller concession?
Right. The seller uses their proceeds to buy down the buyer's interest rate. It makes the loan more attractive to the buyer, which ultimately helps make sure the deal closes.
So points are this giant financial lever that dictates the long-term cost of borrowing. It makes perfect sense why it falls under this loan structuring banner.
Correct. We've established the legal framework and we've structured the financing. Now we can shift focus to Section 3, which covers mitigation, protection, and insurance requirements. These are all the fees designed to minimize future risks for both the new owner and, of course, the lender.
And we're starting with the initial risk assessment, which would be the inspection fees.
Right. These are charged by licensed professionals. Your home inspector, your pest inspector, maybe even specialized inspectors for things like radon or the sewer line.
This is a cost the buyer takes on for their own knowledge, for their own peace of mind.
Primarily, yes. It's the buyer doing their homework to find any potential hidden problems before they are fully committed to the purchase.
But the lender often gets involved here too, right? They can mandate certain checks.
Oh, absolutely.
Yeah.
That interest protection theme comes up again and again. Lenders will sometimes require specific inspections, like a termite inspection.
Why?
Well, if the house has major structural damage from pests or, say, foundation issues, the asset's value is degraded, and that threatens the lender's security. So the inspections serve both the buyer's interest in avoiding a money pit and the lender's interest in protecting the collateral.
And there's that small but critical detail about payment timing. Unlike most closing costs, the sources emphasize that inspection fees are usually paid directly to the inspector at the time of service.
Yes, often weeks before the actual closing date. It's an out-of-pocket cost that hits the buyer's wallet early in the process, and you have to budget for that.
Okay. Moving from inspection findings to future protection, we have home warranties. These are for resale homes, right?
Correct. They provide insurance against unexpected repair or replacement needs for major systems like the furnace, the AC, major appliances, for the buyer's first year of ownership.
And these are a fascinating strategic tool in the negotiation process.
They really are. The cost can be paid by either party. A seller, especially if they have an older home, might proactively buy a warranty and offer it as a marketing strategy. It's peace of mind.
It mitigates a buyer's worries about a big system failing right after they move in.
Exactly. Or, if the seller refuses, the buyer can just choose to purchase one themselves before closing. It's a layer of insulation against the immediate financial shock of a surprise breakdown.
But I'm guessing buyers should always read the fine print on those.
Always. They often have deductibles or service fees, and they might cover a repair, but not a full replacement on a very old item. It's not a blank check.
Right. Now we come to what is probably the most financially significant insurance requirement tied directly to the financing: private mortgage insurance. The dreaded PMI.
The dreaded PMI, yes. This cost is paid by the buyer, and it is mandatory in one very specific circumstance.
Yeah, and what is that circumstance?
PMI is required protection for the lender when the buyer poses a higher financial risk, and the sources are very precise. PMI is required if the buyer's down payment is less than 20% of the purchase price.
Because the bank sees a lower down payment as the buyer having less skin in the game.
Right. The risk of default is seen as higher. So since the buyer hasn't built up enough equity from day one to cover a loss if the market drops and they default, the lender mandates this insurance policy. But the buyer pays the premium.
And that first full year's premium is often paid in advance at closing. That's why it shows up on the settlement statement.
Correct. It's a classic risk transfer. And it's important to remember, the policy protects the lender, not the homeowner.
Okay, so how do I get rid of this thing? I think that's the most actionable insight here. The sources provide a clear roadmap for canceling this expense.
They do. Federal law has established two clear ways to cancel it. Path one is proactive. The buyer can request the cancellation of PMI once their equity reaches 20% of the property's market value.
As long as they have a good payment history.
Correct. That requires the buyer to actively monitor their home value and their loan balance and then make the request.
And what's path two?
Path two is passive, and it's mandated by federal law. Lenders are required to automatically cancel PMI coverage once the buyer's equity reaches 22% of the original appraised value.
That 2% buffer is interesting.
It's a safeguard. It ensures the borrower doesn't have to carry this extra cost indefinitely once they have built up a sufficient financial stake in the property.
Understanding those 20 and 22% thresholds is probably one of the most powerful financial takeaways for any new homeowner.
I would agree. It puts a clear, measurable goal on when that expense can finally be eliminated.
Okay. Finally, in this protection section, we have the general protection of the asset itself. Prepaid homeowner's property insurance.
Also called hazard insurance. This is paid in advance by the buyer, and it protects the physical home against major casualties: fire, theft, vandalism, things like that.
And the lender will always require this.
Always. I mean, the catastrophic destruction of the property means the destruction of their collateral. So no insurance, no closing, period.
And they'll want to see proof that the first year's premium has been paid in full before they release the mortgage funds.
That's right. It's a non-negotiable coverage, but the specific mandates can vary a lot based on where the house is located.
What do you mean?
Well, the sources highlight that flood insurance, for example, may or may not be required. If the property is in a FEMA-designated flood zone, the lender will mandate a separate flood insurance policy, and that can add another significant premium to your closing costs.
So Section 3 is really all about risk management. Inspections inform the risk, warranties mitigate immediate repair risk, PMI protects the lender from down payment risk, and hazard insurance protects the physical asset from catastrophe.
That's a perfect summary. We've covered the legal setup, the loan costs, and the insurance requirements. Now we move into the final category of closing costs, which is all about achieving financial fairness and ensuring final legal compliance.
This is Section 4, focusing on prorations and formal documentation.
Exact.
Prorations. The name sounds complicated, but the concept is actually beautifully simple. It's just about making sure everyone pays their fair share based on timing.
That's all it is. The principle is this. Certain major fixed expenses tied to the property like property taxes or HOA dues are paid on a set schedule, maybe annually or monthly. Since most transactions close on a random date in the middle of a payment cycle, an adjustment, a pro-rata split, has to be calculated.
So each party, the buyer and the seller, only pays their proportional share for the time they actually owned the property during that payment period.
That's it. It's a fairness adjustment, and it's usually required by both the contract and the lender.
Okay, let's use the biggest example here. Pro-rata property taxes.
Okay, so property taxes are assessed annually. Let's imagine a closing date of July 1st, but the annual tax bill isn't due until the end of the year, December 31st.
So the seller owned the property for the first 6 months of the year. They're responsible for 50% of that upcoming tax bill.
Precisely. At closing, the seller owes the buyer a credit for the portion of the taxes that have accrued during the seller's time of ownership. The buyer will then go on to pay the full tax bill in December, but they've already collected the seller's 6-month contribution at the closing table.
It just ensures there is a clean financial break based on proportional ownership time.
Right. And we apply that exact same logic to pro-rata homeowner association dues, HOA. If the property is in an HOA, those dues cover community maintenance, maybe a pool or a gym.
And they have to be proportionally adjusted too.
They do. You don't want to pay the HOA fee for the 3 months the seller was still living there, using the pool. The pro-ration makes sure the dues are allocated correctly based on that closing date.
This fairness principle also extends beyond property expenses to the financing itself, which brings us to pro-rata interest.
This is one paid by the buyer, though sometimes a seller might reimburse it as a concession.
And what timing gap does this address?
This addresses the gap that occurs, because the closing date rarely falls exactly on the first of the month when a mortgage payment is due. When the lender funds the loan at closing, interest starts accruing immediately.
But the first mortgage payment isn't due right away.
Exactly. The first payment is usually scheduled for the first day of the second full month after you close. So if you close on June 15th, your first payment might be due August 1st.
Which means there are 16 days in June, plus all of July, where interest is accruing before your first scheduled payment.
That's right. The pro-rata interest calculation covers the interest on the loan for those extra days until the first full month's payment cycle officially kicks in. It ensures that interest accrues from day one without any interruption.
So prorations are the crucial final math step that guarantees both parties leave the table having paid precisely what they owed for the time they possessed the property or used the loan funds.
It's all about temporal and financial accuracy. Which brings us to the formal documentation requirements, particularly in the U.S. context, that are designed to ensure transparency for the government and, most importantly, for you.
The primary summary document here, historically known as the HUD-1 form, although today it's more often the Closing Disclosure, or CD, is mandatory.
It is. Federal law requires that all residential transactions financed by a mortgage have to document every single closing cost we've discussed in minute, meticulous detail on the standardized form.
This form is the authoritative financial summary of the entire deal.
It's a mandate for transparency. It ensures that both the buyer and seller get a comprehensive, legally required breakdown of all the funds. If a fee isn't on this document, it wasn't officially part of the closing.
And while the specific form has evolved over the years, the core principle is the same, full disclosure.
That's right. And the sources explicitly state that while this document must be provided to the principals, the form itself doesn't always have to be sent directly to the federal government.
So what does the government require?
Well, the governmental requirements often take the form of secondary declarations. A statement by the buyer or seller is typically required to be provided to the local government office that is officially recording the deed. This just makes sure the county has the info it needs for property tax assessment.
And we should mention the federal tax reporting requirement for the seller's side, IRS Form 1099-S.
Yes, this form may be required to be sent to the IRS for reporting the proceeds from the sale. It's mainly to track potential capital gains on the seller's investment.
And there's a crucial consumer protection detail here, right?
There is. The sources are clear that federal law specifically does not allow a charge for the preparation of this tax document. It's seen as part of the standard transactional burden that can't be passed on as an extra fee to the consumer. A small but important safeguard.
Okay, so before we wrap up, we have to acknowledge the catch-all. The list we've covered is exhaustive, but the sources remind us that other items may be unusual or unique to a specific region or a specific type of property might pop up.
Right, like a high-cost environmental inspection or a specific municipal lien payoff. The final documentation, that CD, it has to capture everything.
The complexity of real estate is just astonishing. It's rooted in centuries of property law and then complicated by modern finance.
It really is.
Okay, so we've covered the entire spectrum. We've moved from the human element, the attorneys and brokers, to the financial tools, appraisals, and points, to the protective measures, PMI, and hazard insurance, all the way down to tax stamps and prorated HOA dues.
And if we synthesize all of this for the listener, we can really funnel these dozens of costs into two main operational buckets.
Okay, what are they?
Bucket 1. These are the costs ensuring the legal transfer is clean, recorded, and physically defined. That's your title: attorney fees, transaction taxes, recording, and the survey. It's all about legal certainty.
And bucket 2.
Bucket 2. These are the costs ensuring the loan security and the long-term financial viability of the deal. This is where the lender's mandates live. The appraisal to verify value, PMI to cover a low down payment, points to structure the interest rate, and property hazard insurance to protect the collateral.
And we absolutely cannot forget that the seller carries that massive, often percentage-based burden of the brokerage commission.
Understanding this distinction is power. When you, the listener, receive that detailed settlement document, you are no longer looking at a confusing stack of bureaucratic jargon. You're looking at actionable knowledge.
Because you know which costs are non-negotiable since the lender mandates them, like the appraisal, and which are negotiable, like who pays for the home warranty.
Exactly. Your grasp of this detailed list empowers you to scrutinize every single line item and use the contract to your advantage. It turns what often feels like confusing, finalized paperwork into a structured, manageable checklist of financial terms you've already agreed to.
And this detailed breakdown really connects back to a much larger systemic question. If the average property transaction involves dozens of these unique mandatory fees, from the legal requirement of title insurance and 2 different kinds of government taxes to the mandatory survey, and then the single largest cost, the brokerage commission, is fundamentally set by custom and negotiation.
Yeah.
It raises this profound question of transactional friction. How much does the complex system of property transfer itself? Not the value of the property, but the sheer volume of all these necessary legal and financial layers add to the overall cost of housing.
That's a huge question.
I mean, could simplifying and streamlining these processes, maybe by digitizing title transfers or reforming commission structures, fundamentally change market accessibility and reduce the barrier to entry for millions of potential homeowners?
It's a compelling idea. The process of buying a home is already one of the largest financial hurdles people face. And when you realize that a substantial portion of that cost is just the friction of the system itself, it really makes you question the overall efficiency of our property markets.
That is certainly something to ponder as you prepare to sign that final, very, very lengthy page.
Indeed. Join us next time on The Deep Dive.